Welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name's Patrick Smelly. I'm the editor at BusinessDesk. We have a great BusinessDesk special for listeners and viewers. You can find that at the end of this episode. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Today we're joined by Jeff Greenslade, who's CEO at Heartland Bank. Well, thanks for being with us today, Jeff. I just thought a good place to start would be to just give us some size and scope. What is Heartland Bank? How big are you in the New Zealand market and the Australian market? Where do you specialise? What do you do?
Well, the Heartland Group across New Zealand and Australia is a bit north of about $6 billion in terms of assets. The first thing to understand about Heartland is that we're different. We're not like the other banks. We have a different product range and a different operating model. And of course, we have Australia as part of our business suite, which does make us different. To
be brutal, every CEO is going to say that about their bank. What's different about the business model? What's different about the products that set you aside?
Yeah, so very early on in our journey, what we decided was that we wouldn't succeed just being a smaller version of a bigger bank. They have scale, they have market position, they've got branch networks, lots and lots of people and telephony and all those sorts of good things. So trying to emulate them in the same way that other New Zealand small banks do, we didn't think was going to be successful. So what we decided to do was initially to adopt what we called a best or only strategy. So we'd find products where we could get a leading position, where we could avoid taking on the big banks in particular, and we could obtain market positions where we could extract better returns. So that journey took us into reverse mortgages, motor, asset finance, and livestock finance are areas where we have products which the big banks either aren't present or aren't able to do it as well as we can. And then also that progressed in terms of our channels. So we again made the decision very early on to dispense with our branch network and to reduce telephony and to digitalize our business so that we interact as much as possible with our customer via online platforms. So those two things give us a very important distinction from other banks, both in terms of what the products we offer, but also how we offer them. And again, that flows through to our metrics. So if you look at our performance relative to the industry, we are, again, quite different. So we have higher rates of growth, and that's just a reflection of the products that we have, reverse mortgages in particular. In Australia and New Zealand, we're getting those sorts of, 20% growth rates out of each country, just reflecting that tsunami, if you like, of demographics, the 65-plus-year-olds who are retiring, who are asset-rich and income poor and need something to supplement their income. So that sort of that flow of business sustains us irrespective of what's going on in the economy. So we're not, unlike the rest of the industry, who really are anchored in terms of what's happening in the residential mortgage market.
What's different about the way that you operate in that market? And if that is a profitable niche to be in, which it clearly is, why are others not trying to eat your lunch a bit more aggressively than perhaps they are?
Yeah, that's a question we always ask ourselves as well. And I think, say for reverse mortgages, just to deal with that one, they are a specialist product. There's a lot of compliance that's required, a lot of care and attention to make sure that the customer is aware of what they're doing, that it's the right product for them. And if you look at a major bank with hundreds of branches and thousands of people, ensuring that you're selling those products appropriately is much more of a challenge than it is for a bank that specializes. So we are a specialist bank. We only sell one thing to each of our customers. So we only sell them a reverse mortgage, or we only sell them a motor loan, and we don't try and cross-sell. And that enables our teams to be totally focused on what they need to do to properly and responsibly provide the customer with the service that they need.
So looking out towards the customer, it sounds as if the digitization play is probably more on the deposit-taking side than on the lending side. If you're going to do a good job of selling reverse mortgages to older people who need to understand what they're getting themselves into, presumably that requires, I can see that having a specialist team helps, but it also there's a duty of care, which means that you can't avoid a certain amount of human contact, I'd have thought.
With the reverse mortgages, yes, definitely there is that. There is the need to have that one-on-one bespoke conversation. We insist that our customers have legal advice, but that can happen in a digital sense. So during the lockdown in Melbourne, for example, we still operated doing reverse mortgages without face-to-face contact by doing what you and I are doing now, having video conferences and so forth. So those sort of things do save time and are more efficient. But coming back to the question about digitalization, it's beyond deposits. It's everything we do. We're moving towards platforms where customers can ultimately self-service. We see that the world is moving increasingly towards self-service when it comes to the things that they need most in their lives. So in fact, everything that we need in our life is on our mobile phone. We feel naked without it. We have to have it. And if we can do something on a mobile phone, then that is the best way of doing things. I'd much rather do something on an app than actually have to call up an organisation and wait for them to pick up the call. So, and in banking is no different. I mean, no one wakes up in the morning and says to themselves, you know what, I'd really like to give my bank a call this morning.
I must head down there. Yes.
Yeah. I saw the other day that the waiting times for banks in New Zealand are somewhere between 20 minutes and 40 minutes. Now, that's not a great experience. Whereas if you can do something on your phone yourself and do it within minutes, if not seconds, then that's where I think the service propositions are heading, and that's what we want to be in the forefront of. And the great thing about that, Patrick, is that means that for the first time in my banking career is what is actually best service, i.e. fast and accessible, is also the less expensive. So for a small bank like us, where we lack scale relative to the major banks, we can use technology to replicate scale. And I'll give you an example of that, is that we have an online mortgage product. So it's the only product we offer other than deposits where we do compete with major banks. So we compete for deposits, and we're fortunate enough to be able to use price to avoid competition, but we do compete with the major banks on online mortgages, but with one difference. You can only access our mortgage online. You can't call us, you can't come and see us, you have to do everything online. And because that lowers our cost of onboarding, it means it's very inexpensive for us to take on a new customer, we can offer better rates often than the major banks.
Mm. But that's a normal mortgage, not a reverse mortgage.
It's a normal mortgage. We've just started it. It's been going we started it shortly before the lockdowns. It sort of died a bit, and it's now sort of picking up again, but the market's a bit flat. But we've built that book up to a few $100 million, and it's a very, very niche product. It's for those who feel comfortable doing everything online. It's not all of the market, but it's a percentage of a massive market that we're chasing.
So could we just chop the business up into, first of all, Australia and New Zealand, and then either across the whole of those two organisations or in each territory? What's the split in the book between reverse mortgage and other business? Just trying to get a sense of where your exposure is most concentrated.
Yeah, so we're about 6.5 billion in total, and of that, around about, even for exchange rates, roughly about, say, 2.1 billion is about 2 billion is in reverse mortgages across both countries.
A little bit under a third of the book.
Yeah, so about 1.2 billion Australian and about 800 Kiwi is the split.
And the other four or so is there any predominance in the sectors that you're exposed to beyond that?
No, we're sort of, in fact, that regard, we look reasonably similar to other banks in terms of sector. So we have about, say, just over 60% is in the household sector, which is the reverse mortgages, online mortgages, and motor. And then we have around about 23% in business, and then 17% in agri.
So you made an intriguing comment before, which was that fortunate to use price to avoid competition. I'm presuming that you're talking there about the really quite competitive deposit rates, particularly that you're able to offer. How does that part of the business model work? Does it mean that you have to lend out at higher rates than everybody else? I mean, how are you able to be as competitive as that?
Well, there's two reasons for that. One is we are underweight at the short end of the market, i.e. At call and say, around the 30-day relative to the other banks. So we have less deposits at that end of the market than, say, a normal bank. The reason being is we don't offer transactional banking services, so we don't get that, you don't
have to have a float.
Yeah, we don't have that short-term money. So what that means is we can offer competitive rates, market's best rates at that short end, and we've been given awards for it. And still for us, that's our cheapest cost of funds because it's at the lowest end of the yield curve. So that's the first reason why we can offer good rates, is because the short end is our lowest cost of funds, so we can offer favourable rates. Secondly, our net interest margin is around about 4%. The other banks sit around about 1.8 to 2. So we have a much higher margin to play with in terms of when it comes to competing further down the yield curve for deposits. Why? Because we're in markets, we're not in the red hot competition of residential mortgages. We play in a very small part of it, and we can make that work for us through having a very low cost of onboarding. But other markets we face into don't have the same red-hot competition that you see in the residential mortgage market. And we're offering products which take on an additional element of risk that the residential mortgage market doesn't have. So therefore, we are getting a higher return for it.
Yeah, so it's reflected in whatever interest rate you're able to charge against that. Yeah. Okay. It's still quite. That 4% is impressive. I know it's come back a bit in the last few months. You might want to talk a little bit about why that is. I presume to some extent it's been competed away. But even so, how much of the difference between that, say, 2 to 4 is just operational efficiency versus a careful choice about what you're exposed to, and as you say, markets where you're not effectively commodified or as commodified as many other banks.
Yeah, and I think that last element is the key explanation, is that we don't play in commoditized markets, so we don't get commoditized margins, and that's probably the biggest reason why that margin is much smaller. Further down the financial ladder, we are efficiency is very important to us. So, if you look at small banks in New Zealand and Australia, their cost-to-income ratio tends to be anywhere between 50 to 70%. So it costs, often it costs them about 60 cents to earn a dollar. We're currently at around about 42. So we have the same cost-to-income ratio as a major bank. So, in other words, as I said earlier, we have replicated their scale through technology so that we have the same operating sort of cost structure as if we were an ANZ or ASB through technology. So that gives us an advantage in terms of our results. And another way to look at that is that we started out, when we first started out as a bank in 2012, we made about 23 million. Our current guidance is around, in underlying sense, about 109 for the coming financial year end. So, that's sort of just a little bit less than 5 times growth in earnings. And at the same time, our balance sheet has grown by a little bit more than 3 times. So our profitability has grown at a faster rate than our assets. And usually in banking, those two things, are linear. That you grow your balance sheet growth really dictates your profitability growth. And the difference why our profitability has grown faster is that every year it's costing us less to earn a dollar.
Yeah, certainly. I've shared this for Shared Lunch viewers. If you have a look at the KPMG financial institutions performance survey when it comes out. It's very striking that, I think you're probably a bit above, say, the really big bank, ANZ, for example. I think they're probably more around the 20-something%, but strikingly lower operating costs per dollar of revenue at Heartland. Has that been falling over the time as well? I wonder, obviously we've all had email since forever, but in 2012, with the digital opportunities there in the way that they are today, and is there more that can be done on the digital front?
Absolutely. It's a never-ending struggle. There is more and more automation coming in, more and more technology coming in. It's becoming cheaper and more accessible. What it does take, though, is a bit of courage to adopt it. For example, we closed our branches, and at the time, we had a lot of people telling us that the sky would fall in if we closed our branches. And now, I think from memory, across maybe a $3 or $4 billion book of deposits, we lost something like 20 million. In other words, it was a bad week, and we closed our branches. So it does take a bit of courage to do these things. But if you can break through that, you can get the financial benefits. But also, I think we're on the right side of history. I really do believe our customer base ultimately would much rather do something on their mobile phone than stand in a queue in a branch or wait on the telephone for 20 minutes to get served.
Tell me about the Australian strategy. Where did that come from? How did it start? You've had a lot of activity in Australia for a while, but now we've got the application to buy Challenger Bank. Yeah. Perhaps also update us on where that's at.
Well, it's a funny story. We looked at reverse mortgages, and we liked reverse mortgages. And the thing about reverse mortgages, it's much better to buy them than it is to start the business up, because interest capitalizes. So in the book, on average repays about 7 years. So what that means, if you want to start,
just unpick that for a layperson.
So reverse mortgages are long dated assets, and the interest capitalizes. So customers don't pay interest; you add that to the loan. So from customer's point of view, that's great, because your assets is the house, so you're using your equity to pay for the loan. Now, from the lender's point of view, you face no cash for up to 7 years. So you need to have a very, very sort of deep pocket of cash in order to start the business up. So it's much better to buy a business than start one up. So we found a business we liked, and the deal was if we wanted to buy New Zealand, we had to buy Australia. So, but at the time, our chairman, Jeff Ricketts, who sadly recently died, he was formerly chairman of Lion Nathan, obviously one of the great Kiwi success stories in Australia. So he was keen that we sort of give it a go, and he liked the formula of buying a mature business in Australia with established market share that we would assume. So we bought Australia as part of New Zealand, but now the sort of tail's wagging the dog. Australia has been growing at a faster rate, and it's much bigger than New Zealand, and the runway we've got in Australia is quite massive. So that's what's leading us now to say that we really do need to sort of change our operating model in Australia. We're wholesale funded at the moment, but the growth is such that we need to become a bank to tap into that sort of vast pool of retail depositors in order to fund the growth we're getting in that business.
What have you ended up with in Australia, having made that initial purchase?
So at the moment in Australia, we've got a business which has got, in Australia, reverse mortgages has got 37% market share. So we've got the largest market share in Australia in reverse mortgages in terms of
operating in all states, presumably.
Operating in all states, but effectively, really, the eastern seaboard is our sweet spot. So mostly, the vast majority of businesses is around that southeastern Queensland, New South Wales, and Victoria. That's where the major urban centres are, where we prefer to be. We've got a livestock financing business, which is the largest non-bank provider of livestock finance in Australia. And then we've just bought, conditionally on getting regulatory approval, the Challenger Bank, which is a small $400 million bank in Australia that we're going to convert into a reverse mortgage and livestock bank, plus a few other things down the track.
Just Challenger effectively gives you the sort of the front door in effect, doesn't it?
It does. It does. So what it does is it gives us a faster and cheaper way to become a bank. And becoming a bank means it gives us access to retail deposits.
Yeah. So they've got a banking license already, presumably.
Yes.
And the question is that the Australian regulator, APRA, is it just APRA or somebody else get involved as well?
Reserve Bank of New Zealand also has to approve it. So we've got both sides of the Tasman we need approvals from.
We'll get to the question of listing and being a publicly traded stock and bank in a moment. I just wondered whether, after the results announcement in March, two of the New Zealand brokers, Forsyth Barr and Jardines, both were positive about the bank's prospects. Jardine, I think, put a $2.27 target price on the share price, and it was trading at about that level this time last year. Slipped away to about $1.52. What do you think's going on? Is that to do with people just waiting around for the banking license to come through? Is there something happening sectorally? It's either got something to do with the way equities markets are operating, or somebody somewhere has decided they think something's gone wrong.
I think at the moment, there's a lot of uncertainty around the banking sector globally, and the problem is you all get lumped in irrespective of your points of differences. So the fact that we aren't like those other banks doesn't necessarily alter people's opinion or judgments in terms of the sector. And we're a small bank, and opportunities like this to explain why we are different and genuinely different, not just different in the same way. I think I'm better different. We are different to other banks. Is a great opportunity so that people can understand what drives our success or not. So, for example, as I said earlier, reverse mortgages. There's the macroeconomic conditions that we're seeing have no impact at all on the book. In fact, we are seeing probably more demand, signs of more demand coming through as household budgets are getting squeezed by inflation. So therefore, more people are thinking, well, I might need to borrow more under the existing reverse mortgage or get a new one. When it comes to the impact on property prices, the loan-to-value ratios of our reverse mortgage books are very, very low. So we're sitting around about 20% loan-to-value ratios. So the current drops in Sydney, Auckland, Melbourne prices, all that said, Sydney
pretty survivable.
It's not making material difference in terms of our loan-to-value ratios. To give you an idea, because averages can be misleading, but to give you an idea of, okay, let's look at the outliers. In all of Australia, in a $1.2 billion book, we've only got two borrowers with a loan-to-value ratio in excess of 75%, and none in New Zealand. So even the outliers are kind of very, very sort of minimal in terms of the risk they present.
Do you do any sort of looking out 10 years, 15 years scenario planning around this? Because again, tell me how I'm wrong about this, but just thinking off the top of my head. So I'm a 62-year-old cashed up boomer who likes Heartland Bank because you have great deposit rates and it's not a great time to be in the share market. If I wanted to come to you and get a reverse mortgage, I'm probably, though, at the end of that baby boomer generation. You're going to have fewer and fewer people who are looking for reverse mortgages over time, even though the houses may be worth more, so maybe there's more lending to be done. How do you sustain the reverse mortgage idea, or how do you expand that into? Is there a need to think about the demographics of the group that wants that product?
Yeah, that's a very, very relevant question, and the answer is that. I think I'm safe in saying that the demand for this product in terms of the demographic factors, i.e. the ageing population, will continue beyond what I would confidently say my lifetime. So there's plenty of runway ahead of us. I think, depending on who you talk to, it starts to level off somewhere in the maybe late 2030s or something like that. But it just levels off. It's still going to be quite a strong driver of people coming through. Because it's growing and it will peak and will stay quite a high. We're facing in most countries, the aging population. The average age of the population is moving northwards across most developed.
So let's talk about the strategy for listing. Why did you list in the first place, and at what point did dual listing become the obvious and right thing to do, and how are you finding it?
Yeah, well, we listed when we merged the three entities together to form Heartland. So there was two building societies and Marrick, and then later we brought in PG Rights and Finance. So and we listed for a number of reasons. One is to have access to.
When was that?
2011. So we listed, and we wanted to get access to capital because banks need capital to grow. I mean, that's our fuel. So you need to have a deep and constant source of capital in order to grow. Also, some of the entities coming in were listed themselves. One of the building societies was listed, and Marrick was sort of listed via PGC. So there was it was kind of baked in from the start, but the logic was compelling. So listing has worked very well for us. We have been to the market maybe 4 or 5 times since then, and successfully raised capital. We did so just recently last year. So it's been a reliable market for us to be a part of. We listed in Australia with the aim of expanding our exposure to the market. The thing that the New Zealand is very retail driven. It lacks the same depth of institutional investment that you get in Australia, and so increasingly Sydney is the sort of capital market centre for this part of the world. So having a listing in Australia was very important to be able to engage with Australian entities. Now, virtually no shares trade through the listing in Australia. All the trading happens in the New Zealand market, but because we have a listing in Australia, we then qualify for we're able to be invested in by some of the Australian institutions whose mandates say we have to have a listing in Australia. So it broadens our ability to engage with institutional investors in Australia.
And are you getting reasonable support from Australian institutions at this stage?
We're starting to. When we did that capital raise last year, we managed to pick up some new Australian institutions. I think becoming a bank in Australia is probably going to be pivotal in terms of our ability to engage with the Australians, because I think for all the obvious reasons, I think they're much more interested in understanding an Australian story, less so the New Zealand story. Not that it's not uninterested in, but it's not as compelling as an opportunity that they'd be interested to say, well, what can you do in Australia?
It always strikes me, this is going to sound like a terrible analogy, but a New Zealand company trying to operate in Australia is a little bit like a high-flying woman in corporate life. You've got to do a much better job to get noticed and be taken seriously. Do you find that in Australia? And is there a point at which, if your Australian growth is sufficiently significant, you might have to think about headquartering there rather than here?
Well, that's the first part of your question. We are fortunate we've got 2 established businesses in Australia. One's been going for 15, 16 years, and one's been going for about sort of 6 or 7 years. So both have established positions. Because I think it is tough for New Zealanders to start up in Australia. It's a different market. Behaviours are different, and then you have nuances by the various states. So all those issues we have encountered in our history already and understand and are prepared for. So it's a different proposition for us. The real challenge for us in Australia is, as we were alluding to before, is that we're just unknown. It's reverse mortgages are only just beginning to sort of reach some degree of maturity in Australia. And
are they behind us for some strange historical reason?
No, I'd say they're ahead of us. I'd say that their maturity is ahead of us, but it's still not a well-known product in Australia. I think that will change, but there's still some work to do. So establishing that awareness is probably our biggest challenge in terms of both growing the reverse mortgage book, but also becoming more understood in Australia.
And what's the state of competition in reverse mortgages like there? I mean, is there a point, do you think, at which reverse mortgages become, is there a commodification risk there?
Not at the moment. As I mentioned earlier, to start up a business, it's hard work. You're looking at 7 years of negative cash flow, so it's quite hard to start up. The federal government in Australia has a product that we don't compete against it. It's more at the lower end, but the federal government's involvement in the market gives it some profile and some credibility. And some of the state governments have equivalents. There's a few small credit unions that offer it, but they are small players. And there's another entity which is been going for about 3 or 4 years, which is a non-bank provider. In some ways, Patrick, we're quite keen to see a bit more competition in the market because we're 37% of the market, but we are probably 100% of the marketing budget. And it would, as I said, awareness is the big challenge. The market in Australia is currently around about 3.4 billion or something like around about that. We think the addressable market is somewhere around 10, maybe 15 billion is what the addressable market is.
It's probably less of an issue for a bank like Heartland that's really choosing quite carefully where to play. But you're a bank CEO, so I should ask you the question, which is on everyone's lips, it seems, in New Zealand, is what's your unvarnished view of the true state of banking competition in this market?
I would say that competition for residential mortgages, which is one of the major financial needs that everyone has, would like to have during the course of their career, I would say that is very, very healthy. There is very strong competition, and that is reflected in the margins that you see for residential mortgages. So I'd say the competition, is kind of red hot for residential mortgages. Where I think there are some structural issues around competition are, say, in transactional banking services, which we don't offer. So, I mean, I can give you my sort of objective view. I'm not pushing a barrel here because we don't offer that service. But, changing banks is hard work. And as such a imposition that it does offset a lot of, your ability to withstand, service propositions. So, my personal view is that, like the telco industry, when they regulated the fact you could transfer your phone number if you change providers, I think one day they've got to have a look at you can transfer your bank account with you if you want to change providers, because at the moment, if you change banks, you change your bank account number, and you think about all the things that you rely upon your bank account number for automatic payments, and suddenly your Netflix doesn't work because no longer the bank account doesn't work anymore. So I think that's an area that ultimately needs to be looked at. And I'd say the other area is not necessarily there isn't enough competition, enough people, if you like, probably participating in SME lending. I think that's
why is that?
SME is high risk, and every company is slightly different. So there's always a nuance that you need, and the average loan balances aren't particularly high. So what all that means is that there's not enough scale in the individual lending, to justify all the costs and risks associated with it. I think that has been the challenge.
We've only got a couple of minutes to go. I just wondered if at a high level you could just give us a sense of how Heartland or you are seeing where we are, New Zealand and Australia. We may be at different points in the business cycle. We actually seem to be having a business cycle for the first time in living memory. A lot of people have forgotten what they're like.
Yes.
Just wondered what your view is as to how we might look out into the next, say, 12 to 18 months. What do you expect to see on balance?
It's a very interesting question, because what you're beginning to see is both Australia and New Zealand are adopting different positions. I think when it comes to inflation, you have imported inflation, which you can't control. You've got sort of some of the goods inflation, which is impacted by seasonal factors. So if you have a cyclone and fruit and vegetables are in a short supply, you see the price go up. And then you have services driven inflation, i.e. we want to go out for dinner more, we want to sort of do things. And the Australians appear to be taking the view that they can't do much around imported inflation, and seasonal goods inflation will come and go, and are focused more on the service side. They see that as the most pernicious form of inflation, and that translates into taking a softer approach than, say, New Zealand, where we seem to be taking the view that all inflation is bad, and the way to deal with it is to squash demand. So we're taking a harder approach. Now, honestly, I don't know who's right and who's wrong, but I'd say that there is quite a different approach emerging between the two countries, which we'll see Australia, if they've got it right, will come out of this a little bit earlier. We will take a bit longer, but it may be that Australia has to have a second go at it by taking a softer approach initially. Don't know who's right or wrong, but when I travel to Australia, the sense over there is much more buoyant. They're feeling that they can see that the end is in sight in terms of the cycle. You don't get that sense in New Zealand yet.
Look, thank you very much for your time, Jeff. It's very great to talk. Very interesting to learn a bit more about Heartland.
Thank you.
A listed bank, and it's not owned by Australians, so
no,
worth a look.
No, and buying a bank in Australia, so reversing the flow.
Yeah, excellent. Thanks very much.
Okay, many thanks.
Thanks for tuning in, everyone. We have a special offer for Sharesies investors from BusinessDesk. If you use the promo code SharedLunch2023, you get $100 off an annual subscription to BusinessDesk, usually $249 plus GST. This offer only applies to new BusinessDesk subscribers, can only be used once per subscriber, and can't be used with any other discounts.